Mastering market structure is one of the best things you could do for your technical analysis. So when you're moving with the trend, it's easy to make money. But when you're moving against the trend, definitely you will get killed. It's pretty easy to get wrong because it's so simple. So in this class, I'm going to be teaching you guys everything you need to know about market structure. I've been using this as my core concept for the past 4 years now since I found profitability. It's worked like magic for me, and I'm going to be sharing with you guys. And in this class, it's really open for beginners as well because I'm going to be using proper layman terms, like breaking things down as low as possible, so that even if you have no idea about forex, you can catch up with this. So without further ado, let's get to it. So let's get into basics. Market moves in three main phases: uptrends, downtrends, and consolidations. An uptrend is simply a phase where the market is moving up. Downtrend where the market is moving down. Prices are getting lower, and the consolidation is where the market moves sideways. And if we average it out, basically, price wouldn't have made any movement to the upside or the downside. Now, these three phases are going to be phases of which we are trading. We are going to buy during uptrends and we are not going to sell. We are going to sell during downtrends and we are not going to buy. And when it comes to consolidations, we are pretty much just going to avoid this. We don't really want to trade in consolidations because there's no clear direction as to whether the market is likely to go up or go down. And the idea is we just want to move with an uptrend for the duration of the trend. And eventually the market will give us the signal that it is moving back. And when it starts to show us that it might be moving down, we stop buying and we actually start to sell instead. So these are the three core phases that you need to understand: uptrends, consolidations, and downtrends. Uptrends are for buying, downtrends are for selling, and consolidation are for setting out the market or finding opportunities somewhere else. When it comes to identifying whether a market is in an uptrend or downtrend, there is, in my opinion, a clear cut and correct way to do this. Now, we don't want to use things like trend lines. I know a lot of traders believe a trend line indicates the direction of the market. But the problem with trend lines is actually what you can see just here, where sometimes a trend line will break, indicating to trend line traders or trend traders as a whole that the market is likely to move down. But then it actually just continues moving up. Now, when you think about it realistically, a trend line is just an arbitrary line that you have drawn on the chart, and it's not really giving you any clear insight into real price action. So instead of using tools like trend lines, we actually going to look at the real price structure, which means when we are looking at the market, we want to view the highs and the lows, and they indicate which way the market is going. So it's the most realistic. The most raw way of looking at which way the market is heading. To do this, we use concepts we call highs and low structure, which is essentially what you can see on the charts here. Higher highs and higher lows indicate an uptrend. So where you can see I have written H, this is a higher high, and this is simply a high that is higher than the previous one. Okay, so as you can see, we are continually forming higher highs in the price structure here. Obviously, this is an example, but you will see this on the real chart in a moment, which tells us that this market is endlessly moving to the upside. It keeps going higher, therefore indicating an uptrend. Now, in order to maintain the uptrend, we also have higher lows, and this is showing that the price structure, each low like this one is higher than the previous one. And this one here again is higher than the previous one. Now, this is how we validate the continuation of the trend, because the higher highs are obviously what leads us into profitable moves if we're buying the uptrend. But the higher lows essentially protects the integrity of the trend. Providing the market continues to make higher lows. Then this market should indeed continue moving higher. And the idea for us as traders, which we are going to get into soon, is to buy around these higher low points to catch these larger moves. The reason higher lows are important to kind of protect the integrity of the trend is because what can happen is that the market can come down like this. And push through the low and push through the higher low. Now this would then create a lower low, okay? Because this low that have just formulated at this level is now lower than the previous low, which was indeed a higher low over the previous lows, right? So keep it simple. There essentially, this low is lower than the last one, which tells us that the integrity of this uptrend is now broken, because the market is showing willingness to push lower than previous lows that were printed in the market. So what would this lead into then? Well, generally, what we see after the formation of a lower low is the start of a downtrend. So this lower low might then be followed, and often will be followed with a lower high. Okay, so we can mark that as an LH. This lower high is simply a high that is, of course, lower than the previous one, which is the one just here. This tells us that the market is actually now starting to trend downwards, and instead of moving up. And instead of looking to buy because we're expecting it to move up, we would now shift the narrative and what we would hope to do. You will see a pullback or retracement, as that's also called, to sell in and around the next lower high. We're expecting from this point onwards for new lower highs to form and for the market to continue moving down. So that is kind of how we see trends, using highs and lows and the simple price action way to view the change in the trend. Now let's lock in on this phase of price actions on Euro, Swiss, France. This works on all markets, on all time frames. We are going to go through that high, low structure and mark out this trend. So from where we are going to begin, we're looking at pretty much this high and then our swing low of the entire movement is going to be down here, and then our swing high of where price currently is up here. So we are going to work out the trending direction between the area of perception. So the first thing we can do is just use this path tool to start plotting the trend. We have a high, here we have a low. However, one thing I want to draw your attention to is this low did not push beneath the previous higher low. So this phase of price action following to this move and then down to here is actually just consolidations, okay? Because we didn't break through a higher low, the higher low being this one just here initially. We haven't yet validated or changed the trend at all. So this would be a consolidation. Now we can then see there was a push down here. This pushed us through into a lower low. So this is actually the beginning of a downtrending phase of price action here, okay? Now from this lower low, the market comes up and creates a high. Guess what? This high is lower than the previous high. So this would be our lower high. The market then comes all the way down very quickly to this level and prints a lower low, okay? So now let's mark those on. We have a low or high which is lower than the previous. Now we do also have a lower high just here, which was then validated with the breaking structure that appeared. And then we have a lower low once again. So we can see that each of those lows and each of these highs is lower than the previous one that the market printed. So we can remove this for now and just focus on that structure, okay? I'm going to mark this as well. We have a high. Then we have a lower high, lower low, lower high. How we didn't mark this low? It's because it's not lower low. This low was lower. So this is actually still a higher low until we break this point, which creates the downtrend. So following from this lower low, what we actually see from the market is a push to the upside. Just here, where this high is actually higher than the previous. So this is a higher high, or once again, a kind of transformation point for the market, where we are shifting from moving down to now potentially moving up. So in real time, this would be your validation or your kind of confirming factor to tell you, instead of looking to sell this market, you might now want to start looking to buy. We can then see from that point on using the path tool. So our new trend looks like this: low to high. Then we come in and we create a low here. We don't actually make a break all the way through until this point. Then we come back down and we create a low around this point, which is then followed by a push up, which pretty much take us to where we are now. So to plot this trend out, we can see there is now a higher low, which is higher than the previous low. We then see there is another higher low printed around here, and we can see that there is a higher high printed at just this level when the market made its drive through the highs, just there creating a high that was higher than the previous one. So now let's take a look at what this looks like on the chart. We are going to run through it with the part 2 so you see the full explanation. From the high down to the low is essentially the major first move. This is where we created our first downtrend in price action. But to really refine it in, we have this consolidation followed by this push down, which creates a lower high and validates it with a lower low. The market then comes and creates a lower high, pushes down, validates it with a lower low. The market then pushes up to create a higher high, pulls back down to validate it with a higher low. Then we have this run to create a higher high, which is higher than this previous one. Then we came in to create a higher low and push up to create a new higher high as well. Okay. So that is the overall refined view of the trending market. And this is a market that's shifted from downtrend into uptrend. And you can see both of the directions there. And both of the trends laid on that. Now, one question you might have, of course, because you can see I have averaged out the price action here, is why aren't we accounting for this area? For example, as lows, and that
That is because, of course, this did not create a new higher high. So essentially, any price action that takes place underneath this high is then just consolidation again. We have created our low at this point. We created our high at this point. So anywhere between these two red lines is sideways price action. It's only when the market breaks out above this high that we actually validate this high or low and start looking at new higher lows and higher highs. Okay, so if we don't create a new higher high, then the higher low is not going to be valid. Meaning, basically, this is the lowest point we reached before we broke through here. Therefore, this is going to be a high low. If the market had pushed up like this and then pull back and then push to this level, then this would indeed be our high or low. But for the given example we are looking at, we like to average out to see things for just the simple individual highs and lows, which in this case is going to look like this. Okay, and then on the downtrending move we have consolidations move, but then this is where our trend begins with our high down to our lower low, then to our lower high, then to our lower low. So that's an idea of structure mapped on real chart. Obviously, as you can see, it's not as clean as a diagram, but this is what you're going to be working with.